Accounts payable and other liabilities, Chapter 14. Accounts payable is used to describe short-term obligations. Any obligations arising from normal course of business is accounts payable. Okay, that you intend to pay within 1 year would be accounts payable, and these are the kind of transactions that you would usually pay with that. Long-term debt, interest-bearing obligations, all these things are not part of accounts payable. Interest payable is separate from accounts payable. Okay. Now here we change focus. As we get into the final section, or as we finish assets and we get into liabilities, the objective is not overstatement. Now it is understatement, because think about it. Debit accounts payable, my fault, credit accounts payable, but you debit expense. If you miss that entry or you book it in the next period, you can avoid expense for the current period to show a better revenue. Okay, so that's why typical lawsuits are that they fail to detect overstatement of earnings. Audit of liabilities include understatement of liabilities, which results in understatement of expenses and overstatement of net income. So you are sort of changing the hat in a way that now you're going to be looking for completeness. Existence is also important where there are mistakes, but completeness gains a priority right now with liabilities. Delay in recording of payables. Okay. The most important is completeness. Okay. So delay in record of payables at year end means delay in recording of liabilities and expenses. Therefore, the most important financial assertion for accounts payable is completeness. Overstating assets, the risk is improper entry, and understating is the risk of not making an entry at all. One company's accounts payable is other company's accounts receivable. So it is safe to assume that the other side will maintain the best records possible. You think you owe somebody money, they're going to forget? That's what we're talking about. So confirmation is important over here as well. But here the objectives are, again, risk assessment, gain an understanding of the controlled environment. Again and again, it's redundant, but it is important. Okay. Existence, completeness, which means verifying cutoffs, establishing proper valuation of accounts payable, and accuracy of purchase transactions, and determine that the presentation and disclosure is appropriate. Okay, let's take a look at it. Here are all the controls for accounts payable. Let's review this rule. So when you look at these things, okay, approval of purchase orders to prevent unauthorized purchases, we are going to look. When you read this, maybe you understand this completely, maybe you don't. But when we look at this cycle, it will all make sense. Let's take a look at the cycle. We all understand that first there's a purchase requisition based on which a purchase order is created. Okay. Then the goods are received. The vendor sends an invoice, and then we pay the vendor. We look at the vendor statement and we make sure all the invoices are paid. And this is the process that we want to, as auditors, make sure that it is followed properly. Okay? And we will come back to this after we look at all the steps, because this will then make much more sense. So let's take a look. Purchasing goods and services. Purchase requisition is issued by the department requesting the goods. PO is created. Copy of the PO is sent to the receiving department and the AP department. Okay? Receiving department and accounts payable department. Goods are then received. When goods are received, blinded quantity on the purchase order, because it forces them to count. The receiving report is then issued, okay, and then the receiving report's copy is sent to the accounts payable department. Now think again, you got a copy of the PO from the purchasing department. You got a copy of the receiving report from the accounts payable department, and then the journal entry is done at that time. Now, vendor invoices are received. Okay, Once the vendor invoices are received, they are matched against the original PO and the receiving report and then paid. So what's the process over here? What was ordered was received. What was received was paid. Okay? So these are the 3 steps that we need to understand and follow. The voucher should show which accounts are debited and who checked the invoice for dates, price, and accuracy. The combined documents are called voucher package. What are the combined documents? PO, original PO, receiving report, invoice, based on which a check is cut, and that check is then taken to the entire package is called voucher package and taken to the treasurer for signature. And once the treasurer signs, it should be immediately mailed out right away from that department. Not, not sent back, but right away should be mailed out. It should be stamped, paid, okay, and mailed out. So here's a quick look at these transactions. Here's the requisition, here's the purchase order, and here's the receiving report. Based on which you have the invoice comes in and journal entries are made. Debit accounts payable, credit accounts payable, debit purchase, debit accounts payable, credit cash with the discounts based on the terms, and to make sure that the accounting entry is done correctly. We will still go back to this part, but we're going to continue further. Now, audit evidence of open purchase orders. Let's understand what this is. This is the file which auditors can find evidence on loss of purchases if market prices have fallen below the purchase price. What do we mean by that? Kept open from the day they are issued until the day goods and services are received. And it's called an open purchase order file. Unmatched receiving reports. Invoices from vendors are not received by the accounts payable department, but receiving report is received. The receiving reports are kept in a separate file. They have not been matched with the invoices. And unmatched vendor invoices. When invoices come before this, it's unmatched. When receiving reports come before invoices, it is unmatched. When purchase orders are open, but goods have not been received, it's open purchase orders. Okay? These 3 you can check after the cutoff period to see that they were actually correct and that they were actually filed. And once these 3 are matched, you pick a sample from all of these 3 to match. Then you know that the valuation assertion has been established. Auditors can use this file to match it with unmatched receiving reports to confirm if liabilities are deliberately unrecorded. You obviously are not going to book a journal entry until you match all this. But what the auditors want to see is, did they get this on time but they deliberately did not book it because they want to show less expense? So that's why unmatched vendor invoices gains its own importance. Okay, so this is what you got to look at. Accounts payable, primary audit objective, and I'm sorry this is not in the right format, but it should be primary audit objective is completeness. For accounts receivable, it is existence. Okay, confirmation generally required, not required over here. For accounts receivable, of course, as you know, is required, but you should still do it. And what would you do? And you will see some good multiple choice questions over here. Take balances with 0 balance and confirm. All those vendors with 0 balance confirm and say, we don't owe you money. Please confirm. What are the chances they're going to speak up if we do actually owe you money, or my client does not owe you money? Okay, so for unrecorded liabilities, prepare a trial balance with all vendors with whom the company has done business. Include those vendors with 0 balances. And then make sure the journal entry is done. Once the trial balance is obtained, auditors should perform further procedures for accounts payable. And here it is. These are the assertions. Let's review this real quick before we go back. Now I would say the most important over here is this one. Others are important too, but this one kind of takes its importance, okay? And then here are examples of fraud and errors. At this point, I'd like you to watch that podcast on inventory because it should make much more sense. All right, let's take a look at a bookkeeper prepares a check to himself and records it as having been issued to a major supplier. You should see this as an example actually done when you see that podcast. Ineffective controls. This one is stealing assets over here too, and that is very important. Important over here too, okay? Big differences can have a major impact on how the company is being viewed, in what light is the company viewed. So now when you go back and you look at this cycle, it should make much more sense. Okay, why we do these things? Reconciliation of bank accounts. Reconciliation of bank accounts will help you identify a lot of checks if there is any fraudulent activities. You may want to look at the vendors that have been paid and match it with the regular payments to see if something looks out of ordinary. Okay, but these steps by now should pretty much help you understand what is at stake over here. Anything that does not have, any department that does not have a budget obviously increases the risk. What was predicted and what actually it looks like. All right, so that's about accounts payable. In addition to that, you have some other kinds of receivables. Taxes payable. Match those 940s and 941s to make sure liabilities are booked correctly. Sales tax. Next month is due by the 20th. Make sure they have been booked. Unclaimed wages is escheatable property. Make sure that the state has been notified of the same. Customers' deposits. Unearned revenue. Make sure it has not been booked as revenue. Any other liabilities that have been booked, make sure that it has been booked correctly, because think about it. Credit liabilities, debit expense. All right. Any of this is going to have an impact. This is more for accuracy purposes, sales, unclaimed wages, but anything else is going to have an impact on the net income. That's why it is important. Again, here it is not about overstatement. It is about understatement or not stating at all, not booking at all. Okay, so we sort of wear a different hat over here. And that should be a quick summary of chapter 14. And now you can start with the multiple choice questions.